Hello, welcome to AntKast by Ant Group. It's a podcast that brings you deep into conversations with global thinkers, innovators, and entrepreneurs on groundbreaking technology and how they're shaping our lives for better or for worse. I'm your host, R.T. Warfield, coming to you from London. For this episode, we're going to discuss a new topic for the podcast, and that is how should people new to investing deploy their capital? According to Bank of America, younger generations in the US are saving more than ever. Nearly 3 in 4 millennials are actively saving. Younger generations are also investing at an earlier age. According to a study by the CFA Institute, 31% of millennials with taxable investment accounts started plowing money into them before age 21. During the pandemic, we saw a surge in the number of individual stock market investors. According to Bloomberg, individual stock market investors in 2020 made up an estimated nearly 1/5 of U.S. equity trading volume, a 4% increase from the year before and a doubling from 2010. For more on the topic of investing, we have two, let's say, super experts from Vanguard, one of the world's top investment groups. They will give some professional advice on how to start investing and plan a path to building greater wealth. Globally, Vanguard has more than $8 trillion invested on behalf of its 30 million clients. Maria Bruno is head of U.S. wealth planning research at Vanguard, and Joel Dickson is Vanguard's global head of advice methodology. In our previous episode, Maria and Joel provided their expert advice on how new investors should start saving and investing for their future. In this episode of AntKast, we will continue our conversation with them to talk more about asset allocation and their thoughts on how should young investors invest wisely. So there are many kinds of ways of investing in the markets. I guess there's active investing, passive investing, you have index funds, you could buy individual stocks. Do you want to discuss some of the different ways people can participate in the markets?
Yeah, I'll start, and actually I might peel that back just a little bit, RT, and talk about asset allocation in terms of what type of the actual investment decision in my mind is the last decision. The first would be what are you saving for? What's the time horizon, your risk tolerance, and then select an asset allocation. Okay. And that is how much in the stock market, bond market, or liquid reserves you might need. So once you determine, and there's risk questionnaires out there that one can take to help assess what that asset allocation may be. But we often talk about a balanced allocation. That's roughly 60 to 40% in stocks. And the remainder in bonds. That's a diversified portfolio meant to give growth and some income there. From there, once you pick your asset allocation, from there, you want to think about diversification within that asset class. So, for instance, I have a globally diversified mindset to invest in, home bias, right? Here in the U.S., it's U.S. investments and international investments, but there's a home bias with other different countries as well too. So depending upon where you might live, the propensity might be to invest in those types of markets. But really, you want to have a global mindset and invest because we are a global economy. So it's best to have that mindset when you invest as well, both in the stock market and then the bond market. And then from there, you want to think about how you invest, whether they're indexed or passively managed funds, where the risk is the market that you're investing in, or actively managed funds, as you had mentioned, where there is a portfolio management team who is making buy and sell decisions. So neither one is right or wrong. They can complement each other. It's just understanding what type of investment strategy you would like to follow within those global markets.
I'm just going to add to that by saying...
And Joel, who used to be a portfolio manager, is going to chime in. I was...
No, I was going to say, RT, to kind of the way that you asked the question at the beginning, there are lots of different markets, lots of different ways to participate. I think, as Maria was saying, if we're talking about longer term investing for, meeting financial needs years out, then it's a very different conversation than, oftentimes, you'll see surveys about, hey, what are you planning to use this money for? And, some people, I'm investing for retirement, or I don't really know, or I'm saving for a house down payment, or saving for, kids' education, or, so the goals matter. And then, aligning that, as Maria was talking about, with how much risk you're willing to take, how much you're willing to save, or how much you're able to save to meet those goals. I think it's important to recognize, though, that investing and an allocation and what markets you participate in is really not meant to, I guess, how do I say this? Not meant to substitute for saving the good amounts of money that, whether we use a rule like 10 to 15% over the longer term of your income. It's really about, because that we start getting into this difference between investing or speculating. It's like, I just want more money, or I see that these things are going up. And that's not necessarily an investment plan to meet your long-term goals. That's kind of more a hope and a prayer. It's this combination of setting aside regular investment dollars, having it in a diversified investment portfolio that, captures, if you will, risk premiums of different markets. That is, that you are getting rewarded for some risk that you are taking. And the fact that you might be a long-term investor means that you can have a longer-term time horizon, and you may get compensated for that risk of kind of being in these volatile markets over longer periods of time, or say more volatile than, say, the cash piece of it. So it really gets to this integration of saving, investing, why you're doing it, and then matching that for the type of goal that you have. So when you start thinking about individual stocks and the meme stock craze, or you start thinking about things that, what's the underlying economic value of the investment here? There are many, many types of markets, but you sometimes you kind of say, why are they going up? Is it more supply and demand, or am I getting compensated for taking risk? You think about things like art. You think about, it's funny, I have a baseball card collection that I started when I was younger, but that I have. But I don't know that I would consider that a long-term investment. It kind of gives me some utility, but it's ultimately cardboard pieces of paper, and you're sort of like, wait, how do I think about the value of that? Is there a cash flow that comes from it? Whereas investing equity in a business, you are getting a claim on the profits of that business. And, if that business grows, the economy grows and so forth, then you're getting a return to that investment that is a little bit more straightforwardly seen. It doesn't mean the value of my baseball cards might not go up or go down, but that's more kind of on supply and demand dynamics within that market, as opposed to like an economic value underlying that from a series of cash flows. And so when we often talk about longer term investing, it's how do we capture those risk premiums and investments and diversified investments that are not just a hope and a prayer, but that are kind of going to at least be expected to give you a return because of that economic value of the underlying asset class over time.
So earlier in the conversation, we were talking about the difficulties the younger generation has in trying to balance all the competing, things that need their money, like, paying off debt and, mortgages, et cetera, starting a family. But interestingly, I read that Generation Z, or as you say in the States, Generation Z, are actually starting to invest at a much earlier stage in their life than any other previous generation. And I want to know what the two of you make of that.
Well, I'll start. I think it's terrific. And I do think that there's been a lot of advancements in the investing markets to be able to enable that. So I think about when I started investing just a few years ago, a lot of the focus was on investing and picking the investments or the stocks. Whereas now, as an investor coming into the market, there are globally diversified mutual funds that are very low cost. So it's very easy for me as an investor to get global access in a diversified fund at low cost. So I just have to make one decision, essentially, as opposed to having to make all these decisions and then rebalance my portfolio over time. Whereas now it's much easier. And also through the advances in technology, I don't have to go into an institution and make a deposit. I can actually do everything electronically. So the ease of investing is there, but also the ability to invest at low cost is there as well. So it's much, much easier to make those decisions today than it was previously. So it's when I think about it as a financial planner, it's quite satisfying to see that investors are getting this type of behavior much earlier in their years, because that is, it's a tailwind to set them up for longer term success.
Mm-hmm.
So I'll add a couple of things. I do think there are a couple of significant changes that have allowed, earlier investment. In particular, this concept, and again on the defined contribution plan front in the U.S. especially, and again this is going more and more global. But this concept of automatic enrollment, that when you start in in your working years, you start working coming out of school, that you kind of get automatically enrolled into your employer's, retirement plan. That is more and more common these days, and you have to actually opt out of not being in the plan. That actually will get people. We just see it from inertia through the power of defaults and nudges, behavioral economics, that you see participation rates much higher in retirement plans, which is more early on, where that increase has been in that younger demographic, the Gen Z currently demographic of auto enrollment means people are in plans earlier and investing. Now, that to me is a bit of a structural change that I think will continue. However, at the same time, I don't want to discount that the kind of recent market environments also can affect people's views of saving and investing and so forth. And certainly, what has been a pretty strong return for, let's say, the U.S. equity market, whether certain individual stocks that get a lot of attention every now and then, or even just the U.S. stock market as a whole, has been, something like on the order of 16.5% annualized return over the last decade. You kind of like, oh, okay, well, maybe I should invest there. Now, we would not expect that going forward. Matter of fact, we'd expect a lot less.
Right.
But you look at the recent experience, and that's very different from, let's even go way back. People that grew up in the United States during the Great Depression were much, much more conservative investors. They would not want to put money in the stock market. They would save in a different way, than, let's say, folks that were, starting to invest in the 1960s or early 1970s. And then you had another run of, high inflation, relatively low stock market returns in the 70s, from an inflation-adjusted basis at least. And so you had all of this doubt about equity investments up until, then you had a huge bull market starting in 1982 in equities. And so it's, there is a bit of a current market environment influence on people's thoughts around investing and when to invest. And I think we're in one of those periods right now where it's like, well, yeah, it's a no-brainer. It's an easy decision. It's free money and it's not free money. But that's the That's kind of, I think, a little bit of the view. But I don't want to discount, though, the impact that there's been a huge shift in the pension market around automatic enrollment and defined contribution plans that has allowed investors to get in earlier and in what at least we might think of as more appropriate, globally diversified, low-cost portfolios to help improve their chances for long-term success.
Yeah, those are both all very good points. But besides, the automatic investing and the ease of technology to invest now in low-cost funds, there's also these no-cost individual stock investment apps that are out there that are getting a lot of attention, and people are putting a lot of money into those. I want to know what your views were on that today.
So I'm gonna start by saying, it's not no cost, right? Yeah. I mean, I do think people are like, oh, this is free. No, trust me, it's getting paid somehow, and at the end of the day, it's getting paid through, some lower returns. Whether it's a payment for order flow approach, whether it's the fact that you have to invest cash in a certain way, and the company that's offering it is making money on the cash and on the back end. It's not free. So now that said, as Maria had pointed out, different types of investments are much more accessible than they had been. And some of that is due to just the changes in markets over time, decimalization, in certain markets, the ability to do fractional shares of securities and so forth has made now smaller dollar amounts or initial investments much more accessible into different markets than maybe they had been in the past. I do think, though, if we're talking about longer term investing approaches, then what you do want to think about is diversification, not this kind of, I refer to them often as lottery tickets. A lot of what people talk about as investing is, at the end of the day, lottery tickets. It may pay off, it may not. Oh, I think XYZ is going to triple or quadruple or go up tenfold. Okay, fine. If it does, then great, you're set. But, it's also more likely, just as likely or more likely, that it gives you a negative return or you lose your money and so forth. That's why the power of diversification, it's in many ways the one free lunch of investing, is diversify in individual security risk by investing in similar types of securities, the equity market instead of one equity stock. If your goal is longer term investing, that has been a kind of proven time and time again that's a good approach. So a diversified portfolio, and again, it could be of individual stocks, if it can be done in a low cost way. But I think sometimes we get trapped into just hearing the stories of people that, oh, well, this stock they invested in and it went up 300 or 3,000%, and look, you can do this too. The fact is that is the vast, vast, vast minority of outcomes, and broad diversification will win out on average over time. So I probably didn't quite answer your question there, RT, about the investing apps, but this gamification that has occurred, I think it has significant upsides and significant, but at the same time significant downsides. The accessibility, again, somewhat market structure approaches have been a positive. It's democratized in many ways the accessibility of different markets and different approaches. But at the same time, this kind of horse race almost mentality, competition to have the best return, or hey, look what your balance did today versus yesterday, can really generate some what we would think about as bad habits in not thinking about longer term and not thinking about diversification. And those types of principles long-term diversification, low cost, things that you can control as an investor, much, much more powerful than the hope and the prayer or the lottery ticket, which may pay off, but oftentimes does not.
It's funny when Joel's, the way I would have addressed it, the same thing, Joel, that I was going to say there's no free lunch when it comes to investing. We talked about the employer match, but the, we need to invest in order to gain that company match, for instance, here in the U.S. So you just be careful of, I would offer caution and careful when it comes to things that seem too good to be true when it comes to investing, because there is some type of cost in there. It may not be transparent.
Right. So too good to be true, would that come from where maybe a good portion of Generation Z investors seem to be getting, their investment ideas from YouTube and online sources, meme stocks? Does this kind of go against the long-term thing you were talking about earlier? Well,
this is with anything in life, right? We can really get into social channels and get sucked into different things. And information is good, but I think you need to understand where the source of the information, the credibility of the information, and then just make sure that if you can't explain something to someone, then that's a problem, particularly when it comes to investing. So you really want to be clear and understand how something is structured, what you're paying for it as an investor. It may seem free, but really understand the mechanics behind something before you jump in. That is investing, but it's also, with many facets in our life as well.
And I would just add that I think a lot of, you think about the meme stocks and, you love to be able to go to a cocktail party and, or talk with friends. Oh yeah, I've owned Tesla since, my $10 has grown into, 10 million or so it seems sometimes with the way that folks talk. I look at a broadly diversified portfolio saying, hey, you know what? I own Tesla too. Right. You are getting that participation, but you're getting it in a more measured way because all of those other stocks that maybe have not done so well, although you've held them, you didn't hold them in such a concentrated position that now you've put your goals at risk because of the outcomes of that. What I would say is when we start thinking about the meme stocks, or you think about, betting apps, gambling apps on your phone. You think about, other types of things. It's sort of like, oh, well, it's gone up. Oh, I think I'm smart. I think I can do well at this. There still may be utility at it. I'm not saying don't do it. It may be fun. It may be interesting. It may be a hobby, but it's not investing. So, understand what is it that you need in order to meet your goals over the long run and invest those proceeds. If you want to have some fun with some other things, and it's money, for example, that you don't need to maintain your standard of living, to meet your goals, and so forth, fine, have at it, whatever you want to do, that have fun. Some of us, go to music concerts and spend a lot of money to get, front row seats. Okay, fine. That's where I want to spend my money. It may be that they are doing, a gambling app and betting on their, local sports team for fun, or that it's like, hey, maybe I'll take a little chance on this meme stock because, hey, it's interesting. But it's, again, it don't put the money in those very concentrated, more speculative sources that you actually think you're going to need to meet your long-term goals. That's kind of the difference there.
Right. Yeah. I had an aunt that when we go to Las Vegas, she would have, only have $100, and she said, "That's it. That's all I'm gambling. Nothing else." Right. She wouldn't, and then that's it. When she ran out of the money, that's it. She'd leave the casino. And I guess it's kind of like the same idea.
Yeah, it is. And it's not to say, because I think sometimes we in the wealth management space often get this tag of, you're just telling me to not spend as much as I do. Just understand what you need to meet your goals. have fun with, what brings you joy, what brings you pleasure. Yeah, definitely do that. Just understand the difference between investing, though, and meeting long-term goals versus speculating, and you're doing it because, hey, you like doing it. Great.
That's a very important distinction, speculating versus
RT,
investing.
your example gave me a little bit of a chuckle because I used to be a financial planner and work with clients, and I would have sometimes married couples where I would have one client, one spouse would be very, very risk averse, then another spouse would want to dabble. So I'm like, look, you can have a little pot of money and you can dabble in that. And that was fine. Then the one spouse had, his or her little pot of money that they could play with, but yet the remainder of the portfolio was well diversified, and it gave the other spouse ease. So it did put a little bit of a smile on my face because it's okay, but you can't do that with your entire portfolio.
So that's the whole point. I think between investing and speculating, and it's really good advice, especially in a marriage, right? You definitely want to set that up, make that clear. Okay, honey, you can have this little pot of money to play with, and just make sure that's the money you don't need for future goals or for necessities, right? One last thing before we go, and that is you mentioned lottery tickets. The idea of cryptocurrencies as an asset class, do you also see that as a lottery ticket?
I guess what I would say is I don't see it as an asset class. I mean, there's kind of this argument, is it like digital gold? Is it a store of value? Honestly, I don't see that at this point in time. What we are seeing with cryptocurrency is it's a transaction medium. It provides access to a new to basically, if you will, technology, blockchain, and that the innovation that is occurring there is really mind-blowing in many ways, and just starting to tap what might be possible, and we just don't know. But I mean, cryptocurrency in itself to me is a little bit more like a supply and demand asset when we talked about that earlier, which is, its value is kind of defined by what somebody else is willing to pay for it at that point in time without really clear underlying economic fundamentals of what the asset, kind of the cash flow that would be generated from it and so forth. Now, I would compare that a little bit to the technology or the use cases for which cryptocurrency may be used. Just like, cash is paid to a business, it kind of makes everything run in, physical cash terms, and the businesses themselves will generate then cash flow from investing that amount and so forth. So the business may be quite valuable. I struggle sometimes with the cryptocurrency piece of it. It seems a little bit more at times like a bit of a speculation type about this cryptocurrency is going to outperform this one and so forth. And there will be winners, there will be losers there. But from an investment standpoint, I just don't see the investment case other than the underlying technology may build businesses and generate cash flow. But the cryptocurrency itself as an asset class, I just don't see it at this point. Again, though, it is fun, and I have to admit, I watch what cryptocurrencies are doing all the time and try to understand the use cases, potentially great means for international transaction mechanisms and all sorts of different ways of dealing with transactions and security and so forth. So I think there are a lot of potentially great use cases that could be monetized in many different ways.
Right.
But just like in many ways, we typically don't think of gold as an asset class, even though its price fluctuates. It will be based a lot on supply and demand dynamics for gold, whether it's for industrial use, personal use, and so forth. But it's not generating in and of itself an underlying cash flow. It's more kind of supply and demand dynamics in the marketplace that are driving the price. So I just don't see it in the same category as a broadly diversified equity or fixed income type investment
Right.
that has a source of cash flows underlying it tied to economic fundamentals of whether it's various companies or economy as a whole.
When I get this question, my first thing is that I let out a sigh. And then, because I know it's going to be a wishy-washy answer. Right? No, it's okay.
Sorry.
As Joel finished, he's like, I know it's a wishy-washy answer because it's going to be a wishy-washy answer with some of this. It's like, okay, I get it, but it's not an investment portfolio, right? So it's like, how does this all fit together? So,
right.
But it is interesting enough, and it does open up, as Joel mentioned, the
yeah.
potential for use cases here. But, I think there's a lot of caution with this.
Thank you so much for sharing all this excellent advice and helpful insights into investing. It was very educational indeed. It was a great pleasure having you two here. That was Maria Bruno, head of U.S. Wealth Planning Research at Vanguard, and Joel Dickson, Vanguard's global head of advice methodology. Many thanks to you both.
Thanks, RT. Good to be here.
Thanks, RT.
That's it for this episode of AntKast. To make sure not to miss a single episode, please subscribe on Apple Podcasts or Spotify. I'm RT Warfield, coming to you from London. Thank you for listening. Bye for now.